Welcome back, everyone. Our next speaker for this morning is Lara Dalmeyer. Lara is a portfolio manager at Apex Investments. She and her team manage the Nedgroup Investments Flexible Income Fund. Lara, a very warm welcome to you, and thanks for joining us.
Thank you for having me.
Lara, so let's just jump straight into performance then. I mean, the fund did have quite a good year last year. Can you please talk us through where that performance came from?
Yes, thank you. So the total gross return for the year was 11.3%, which for an income fund is a phenomenal return. But it was a very conducive environment to strong returns. We saw particular strong returns from South African government bonds. Credit was strong, although not to the same degree. Inflation-linked bonds also provided strong returns. Property provided very strong returns. So as you can see from our chart, if you look at the attribution of performance for the year, you can see we really managed to generate returns across all asset classes in the fund, which ultimately is what we like to do. We like to generate returns from a variety of asset classes. But yes, it was an easier year to do well last year because you almost couldn't go wrong.
Yeah, that's for sure. And it won't be like that every single year either.
No, certainly not. Certainly not. And while it's nice to look back at a good return for the year, we will always think we should have had more, and it would have been nice to have even more bonds, would have been nice to have even more property. But so even when you win, you lose.
It would be nice if you could invest in just the best performing asset class every year. Anyway.
Exactly.
But Lara, I guess turning to some of your market views now, how would you describe the world economy at this point? Is it a happy place or not?
It's a hard question to answer because, I feel like a lot of the narrative out there at the moment is very negative. And I don't think that is necessarily the case. You hear a lot of commentary around, growth is coming down and inflation's still staying high and this and that. The truth is yes, growth is coming down. It is moderating. But we certainly don't see it falling off a cliff. If you look at kind of IMF projections in the US going from 2.8, which was a very strong year for growth in 2024, looking at 25, 26, it's about 2. That's not terrible. That's still quite a robust year. Then if you look across EU, Japan, UK, on trend, you're seeing a bit of a moderation. But on average, it's still quite strong. So while there is a lot of nervousness, I feel, in the market narrative, it's certainly not 100% true in the numbers as of yet. When it comes to inflation, I think the trend is that inflation is moderating around the world. It is coming down. The difficulty is the US, and I think perhaps the US is a bit of an exception there. What you are seeing, or what you were seeing, is you were seeing very sticky inflation, particularly in the core services portion of the inflation basket. And that was really linked to the fact that you had this very strong economy, very strong labor market. That has been moderating, and that is coming off. The difficulty now, however, is you saw very subdued goods inflation, but now off the back of tariffs, that's starting to rear its head. And I suppose the extent of that is what is a bit unknown, but it does feel like that, given policy that we've seen and could likely expect to continue to see, it does feel like that portion might continue to keep the US inflation number in a bit more of a difficult position long term. Just going back to growth and going back to forward economic outlook, I think what is very important to remember is we are still seeing very, very easy policy, both fiscally and from a monetary policy point of view, globally. That is a very conducive environment for financial markets. If you look at the primary balances of countries around the world, you can see just how loose fiscal policy in general still is. And barring Japan, which has been in a different monetary policy cycle for a very long time, if you look at, interest rate expectations going forward in the US, you look at EU, you look across the world really, monetary policy is still easing. So it is hard to see this kind of, all chips down scenario play out. But, we can maybe get to that, when we talk longer term. But looking at things right now, the environment is still quite conducive. So we can't be too negative as of yet.
Yeah. I mean, I would like to pause you because you mentioned about longer term. I definitely think we need to zoom into that a bit. What does the big picture look like at the moment? And what are some of the key risks on your radar at the moment?
So while, if you look at the numbers right now, everything still looks like, we hate to use the word because it's soft landing. There's no kind of hard landing scenario yet that we can see play out. There are a lot of risks. And I think this is more what the market narrative of being a bit uneasy alludes to, is that there are some tail risks that have presented themselves over the last year or two that we are not used to as financial market participants, and where the outcome becomes very much unknown. So the IMF printed this it's quite an interesting chart where they printed what is the global sentiment index versus the policy uncertainty index. If you look at sentiment's good, it's decent, it's quite strong. But if you look at uncertainty, it's absolutely skyrocketed. And I suppose that's more around our long-term considerations, is while we don't know exactly how things play out, we do need to keep these potential negative scenarios in the back of our mind. And I've listed a few there. First thing is trade and trade uncertainty, this constant revision of what growth could or should be, because trade is a large generator of GDP, and these numbers can change, at the click of a finger. Labor supply dynamics, that certainly is on a negative trend, and to what extent and how quickly that will affect growth numbers, I suppose at this point is unknown, but I would imagine that over the medium to long term that will have a negative impact. Fiscal policy, we can say it's easy, it's supportive, but at some point, what do they say? The chickens have to come home to roost. You can't just spend and spend and spend and bring demand from the future forward. And
can't you just borrow more?
Well, everyone's on that train at the moment, and the market hasn't punished them yet. But it does become unsustainable. It becomes completely unsustainable. You just keep using larger and larger parts of your budget to finance yourself. And that's fine when interest rates are low. It becomes very expensive when interest rates are high. And at some point it does become unaffordable. So, most developed markets, the US in particular is highlighted with this massive climb of debt to GDP, huge debasement of the dollar. That's just continuing. It can still carry on for a long time, but at some point there does need to be a reconciliation. And you can see the bond market's nervous about this in the US. That steepness of the US Treasury curve is very apparent. And you can see bond markets are starting to become very aware and very nervous around this let's say, policy that isn't seeming to go anywhere.
Yeah, I mean, you mentioned about bond markets. We must definitely talk about that in more detail.
Yes, for sure. We will in a sec. The other two, high commodity prices, great for the SA fiscus, not so great for consumers globally. And then, of course, again, this is very US-centric. Governance and institutions like the Federal Reserve, where their independence is being challenged, that could have potential huge market repercussions. So this is all background noise that you can't really put anything on, but you do need to be aware of as an investor at the moment.
Anyway, so
Markets.
turning to bonds and valuations and markets, which you
Yes.
know is obviously a key part of your
Yes.
investment process.
Yes.
What are your thoughts on kind of South African bonds and the ZAR at the moment? That is a big sigh.
Because we keep thinking they're expensive, and we keep looking a bit silly saying that. So let's give it a bit of a broader context. Is the local bond market has been, we want to say, at the mercy of a big change in policy, the inflation target. And your long-term inflation forward expectations is a big part of how you value bonds, right? We've put the little model there on the table where what you would do is you would say, what is the global risk-free rate? And that's another assumption that we're making, is that the US has historically been the risk-free rate. Perhaps there's an argument that changes, but
maybe use gold next time we meet in the world.
For consistency, let's use the US 10-year real rate. You add your long-term inflation expectations on top of that. You add a bit of an inflation risk premium, plus your country risk premium, and that should give you where your SA 10-year bond should be trading. So our 10-year bond is now trading at about 8.6%. US tips, 10-year tips, so the real risk-free rate is at about 1.9%. On average, that inflation risk premium has been about 30 bips historically. And then you've got your two other inputs, okay? Where is your inflation? And what does that inflation mean for your implied country risk premium? So let's give the SARB, the central bank, full credit that they will, over the next 10 years, average 3% inflation. If we give them full credit immediately, the market is saying the SA risk premium, country risk premium, is 3.4%. For us, that is probably about fair. Assuming, however, that there will be a few teething issues and inflation comes down slowly over time, inflation would average higher than 3%. Assuming they get absolutely nowhere and they do 4.5%, the midpoint of their old target, the country risk premium is 1.9%. So that is way too low. That is signaling bonds are very, very expensive. The reality is, though, is that the risk premium, or the implied risk premium in our bonds, is somewhere in that range. Somewhere in that range, let's assume a midpoint, for us, is starting to look expensive. I would say 3.4 is fairish. Anything below that is starting to move expensive, or on the expensive side of fair. So we are not seeing huge value left in South African government bonds. But having said that, there is a lot of momentum behind these bonds. And there is a lot of talk around SA positive sentiment, which is lovely. We haven't had that in a long time. So there's also talk about, perhaps anchoring at our old risk premium is no longer applicable. And we need to be bringing that risk premium down off the back of better growth, off the back of stronger fiscal, off the back of better logistics, etc., etc. So one can make that argument, but from where we sit, we need to unfortunately see that in the numbers first. If you look at forward growth projections, whether you look at IMF, World Bank, the credit agencies, we're still struggling to get to 2% real growth. And unfortunately, that's what you need to really get your fiscal dynamics, really start to taper off and start to look better. But there is so much noise in the market at the moment. Perhaps commodity prices just continue doing what they're doing. Production stays strong, and perhaps that's all we need for a better fiscus. Perhaps we don't even need the better growth. So there is a lot that you can argue here on where the parameters should exactly be on a fair valuation. But from our side, even if you start to just average, it's starting to look expensive. There doesn't seem to be that much joy left in nominal government bonds. I will, however, say that the front-end inflation-linked bonds, where you can see those break-evens, low threes, that's very low. That's giving the SARB credit very quickly. And from where we sit, while we believe the SARB is highly credible, new inflation expectations take a while to filter through. So to say that to 27, 28, 29, 30, that your break even should be that low, as market people, we would be buyers there in saying that we believe it would probably be a little bit higher than that. So in the front end of the curve, we do still like the inflation-linked space. But on the nominal curve, it doesn't look like that much value to us anymore. Not to say duration goes to nothing. We are a bit more neutral here, and selling down as the rally continues.
Great. And Lara, maybe just quickly on the ZAR before we turn to portfolio positioning. It's obviously strengthened quite significantly over the past year or so. What are your thoughts at this point?
The Rand has performed phenomenally well, and I suspect, given what's happening with our terms of trade, it will continue to perform phenomenally well. There's a clear distinction, though, talking about Rand strength versus Rand dollar cross. So the Rand has or is looking quite a little bit expensive if you look at our fair value model, but it is probably not as strong as what the USD cross is suggesting, because you must remember there is dollar weakness at the same time. Having said that, though, if you look at a trade-weighted basket, the Rand still has done very well, and it is maybe starting to trade marginally expensive, but it hasn't completely fallen out of bed. This can really do a lot. And the thing that you need to remember with currencies is they tend to overshoot. They tend to overshoot on the weak,
both ways,
and they tend to overshoot on the strong. And now you've got these terms of trade tailwinds that will likely continue, if not just keeping it in strong territory, perhaps even strengthening it further. Slightly less conviction against some of the other major crosses, whether it be against the euro or the pound. But we do, versus the dollar, we've got a view that Rand will likely continue to be strong, but we also have the view that dollar will continue to be weak. So there, in particular, you might see a bit more of a move.
Maybe I can take my Rands and find some assets in Japan, Korea, and Taiwan to buy.
Exactly. Yeah, so it's fantastic to see. It certainly hasn't overshot all expectations yet. So so I think the way we are positioned is we've just again moved into more neutral territory.
Thanks, Lara.
Yeah.
And I guess just to end off for today, then let's talk about portfolio positioning. And you and Phil run the fund very conservatively, and it's been great because it's worked well for a long period of time, and it's also helped you to avoid some of the many blow-ups that we've seen in the market as well. So well done again on that. What are your thoughts on current positioning then?
Well, as we said, we should perhaps have been less conservative last year, but I think in general, the way in which we've run the fund, has very much been with that income mindset, that clients in the fund want a strong income with a high degree of capital preservation. Look, going forward, I think yield is going to be harder. You don't have these obviously cheap markets anymore. But if you look at how the fund is positioned now, I think the fund is well positioned for the next year. The fund's got a very strong 12-month forward yield, still at 8.2%. And if you look at the floating rate portion of the portfolio, which is the majority of the portfolio, almost 54%, we have done a lot of work in putting together very attractive bonds in that portion of the portfolio that is yielding about 1.6, 1.7% above money market. So, even if asset classes are a bit stretched, you've got this very nice, strong underpin on the vast majority of your portfolio that also has a very high credit quality. We have started to reduce our nominal bond duration slightly, not to a huge degree. We are still sitting at 0.6 years nominal duration, but while we do see some strength in the nominal bond space as this rally just continues, we have just been taking a little bit off the table. We're still sitting at about 0.3 years in the ILBs, in the inflation-linked bond space, very much in the short end of the curve there. where you're still getting over 4% real. That's a very, very nice holding for a fixed income portfolio. Offshore, our duration is low. We're only sitting at about 0.1 years, and that's all in the inflation protected space, given our view that inflation in the US will really struggle to meet, the old 2% target. But given this perpetual steepness in the curve, this very, let's say, exaggerated fiscal position that we see in the US, continued dollar debasement, it's not a big position that we want to have in the portfolio. So you will see that in our offshore positioning, it is small overall, but it is more floating and protective in nature than to really try and go out in the curve and buy duration there. So yeah, we think that the portfolio is well positioned for the year ahead. It is conservative, it's robust. If bonds don't do what they did last year, that's very all right. Yeah, and I suppose last conclusion there is that our dollar exposure must not be thought of as our offshore exposure. We do hedge the vast majority of our currency back into rands. Our effective dollar exposure is only at 3.7%, just alluding to that more neutral currency position that
helps minimize volatility in the fund.
Exactly. Well. No, I mean, if we didn't have dollar hedges, you would just have the returns of your fund being driven by what the currency was doing, which is certainly not desirable for an income fund. So yeah, we maintain, the fund to give a very strong yield over the next 12 months. We don't have any major bets on the table. It's well diversified. And yeah, as things continue to rally, we just slowly take profits and try and build up that floating rate portion of the fund as much as we can, which ultimately is the most durable for clients.
Lara, brilliant. Thank you so much.
Thank you.
Great, and all the best for the year ahead.
Thank you very much. Thank you.